Some of the biggest and most profitable tech stocks have barely moved in 2 years. Meanwhile, the NASDAQ has exploded upward by 70% in that same window. And that mismatch, that gap, has created what I genuinely believe is a powder keg opportunity. Not a maybe, a real, specific, data-backed opportunity that most people are going to completely miss because they don't understand the mechanics behind it. I'm the guy who bought oil stocks 6 months before the war broke out. Not because I have a crystal ball, not because I got lucky, but because I could see the big money moving into that sector before most people were even paying attention. I'm up about 60% on that position right now, while the S&P 500 returned roughly 9% over the same stretch. That means I made approximately 5 times what the market gave people who just sat in an index. And I'm telling you that not to brag, but because I'm seeing the same kind of setup right now in software stocks, and I think this rotation could be even bigger and move even faster. Here's why. The big money, institutional money, hedge fund money, the money that actually moves markets, it no longer sits still. It doesn't plant trees anymore. It surfs, and it's moving faster than ever, bucket to bucket, sector to sector. One rotation finishes, and the next one begins before most retail investors even realize what happened. The truth that nobody on financial television wants to say clearly is this. Wall Street stopped caring about fundamentals the way they used to. They don't care about management quality. They don't care about earnings growth in isolation. What they care about, what drives the actual movement of stock prices in the short and medium term, is momentum. That's it. Momentum and positioning. I know that sounds fickle. I know most of you were raised on the buy and hold philosophy. Your parents believed it, their advisors told them it, and for a long time, in a slow-moving world, it worked reasonably well. But here's what's changed. The speed of technological disruption is so fast now that a company that looks unshakable today can become irrelevant in 18 months. And if you're sitting in that stock through the whole ride down, buy and hold didn't protect you, it trapped you. So in the next 25 minutes or so, I'm going to break down exactly what's happening in software stocks right now. I'm going to explain the mechanics that are setting up what could be a major move. I'm going to give you the ETF play, the simple one-click version. And then I'm going to walk you through 3 specific stocks and exactly why each one is on my radar. I'm in the south of France right now. You can probably see that in the window reflection. But the information I'm giving you here is the same information I'd be giving someone sitting across from me in any serious investment conversation. So stick with me. Let me show you the mismatch first, because this is where it all starts. Over the last 2 years, 2 things happened simultaneously, and they pulled in completely opposite directions. The NASDAQ 100, that's the index tracked by the ETF called QQQ, went up roughly 70%. If you put $10,000 into the NASDAQ at the start of 2024, you'd be sitting at around $17,000 today. That's a solid outcome by any standard. But here's what most people missed completely. The biggest software companies in the world, the ones that are supposed to represent the future of technology, they didn't just go up more slowly than the NASDAQ. They actually went down. We're talking about a decline of roughly 8% across the software sector over the same period where the broader tech index went up 70%. So instead of turning $10,000 into $17,000, software investors are sitting at about $9,200. While everything around them was flying, they were going backwards. How is that possible? Software is supposed to be the future. Everyone says that. How does the future go down while everything else goes up? That's the question. And the answer to that question is what makes this opportunity real. Let me tell you what Wall Street decided to believe, because this is critical, and it's what has driven 2 years of underperformance in software. There is a narrative on Wall Street, a very powerful one, powerful enough that the biggest, smartest hedge funds in the world have been betting billions of dollars on it for 2 straight years. And they have made money, real money, on this thesis. Their story is simple. AI is going to kill the software industry. Why pay for a software tool when an AI can do the same thing faster, better, and for a fraction of the cost? If you're running a company, why buy 50,000 software licenses when AI just does it all for free? That narrative, scary as it sounds, is what drove hedge funds to short software stocks in a massive, coordinated way. As of the latest available data, those funds have collected roughly $24 billion in profits, betting that software stocks would go down. $24 billion on one directional bet. Think about what that kind of positioning does to a market. Think about the boat analogy. If every single person on a boat runs to one side, the whole vessel tips that direction. The more people pile on, the more lopsided it gets. That's what happened to software stocks. Institutional money ran to one side of the boat, the short side, and they pushed prices down. And they made money doing it, which attracted more money doing the same thing, which pushed prices down further, for 2 years. But here's the thing about a boat. The more crowded one side gets, the more dangerous the tipping point becomes. At some point, people on that side start looking around and going, wait, this thing is about to flip. And when that moment hits, everyone runs to the other side at once. That's not a thesis, that's physics. And this video isn't about whether AI is actually going to kill software. I'm not here to debate that. Honestly, it doesn't matter for what we're about to talk about. What matters is understanding the mechanical forces that have built up on one side of this trade, and what happens when those forces reverse. Let me put this in context before we get to the actual stocks. The old model of investing, buy a great company, hold it forever, check back in 20 years, worked when the world changed slowly. When Nokia was the world's top phone company, it stayed there for a while. When Cisco was the most exciting tech name in the market, it had years to enjoy that status. You had time to sit in a position and ride a cycle. That world is gone. AI and technology disruption now move so fast that a company that looks like a towering oak today can get reduced to chopsticks in under 2 years. We saw it happen with Nokia. We saw it happen with BlackBerry. And look, I used to love my BlackBerry back in my banking days. You can do the math on how long ago that was. We saw it happen with Cisco. The money flowed in, stayed for a while, and then left, fast. And the people still holding when the money left paid the price. So what do the professionals do? They don't marry a stock. I always say, don't marry the stock. The best investors treat each position like a chapter, not a life sentence. They get in when the setup is right, they ride the move, and they exit before the crowd figures out what's happening. That's surfing, not planting. Now, the reason I'm bringing this up right now, the reason this specific moment matters, is the IPO summer. Companies that have been sitting on the sidelines for a decade are about to list publicly. Not just SpaceX, which everyone's talking about. There are dozens of high-quality companies quietly preparing to come to market. And historically, IPO boom cycles kick off a 5-year run of wealth creation that touches nearly every corner of the market. We saw it in 1998. We saw it in 2010. We saw it in 2020 with Airbnb, Coinbase, Roblox, Rivian. People who understood the cycle and positioned correctly in those windows made generational money. Where were you in 2020? Did you participate? Or did you watch? Or worse, did you buy in, made some gains, and then hand them right back to Wall Street because you didn't have a framework for when to sell? Be honest with yourself about that, because nobody builds real wealth by accident. The people who actually change their financial trajectory for themselves, for their families, for their kids, they do it by recognizing patterns and acting on them with discipline. The IPO summer is one of those patterns, and right now, we're standing at the beginning of it. 5 years from now, you'll be in one of two groups. Group 1, the people who watched it happen, again, just like 2020, just like 2010, just like 1998. The people who said, I knew about that, but never actually moved. And Group 2, the people who showed up, did the work, learned the framework, and built something real. something that lasts, something for their family, their retirement, their legacy. Ask yourself one question right now. If your income stopped tomorrow, completely stopped, would your family be okay? Would you be okay? Not in the catastrophic worst-case sense, just the question, did you build something that can carry them? Because that's the real game. Not picking stocks for sport, building a financial foundation that actually holds. And I want to be crystal clear. I'm not saying go buy every hyped-up IPO that comes out. That's how you get wrecked. What I'm saying is learn the skills that let you tell the difference between the real opportunities and the noise. That skill set is worth more than any single stock tip. Okay, let's get into the actual framework, because understanding the idea isn't enough. You need to know what to look for and how to act on it. I call this the rubber band effect, and it works because human nature doesn't change. Doesn't matter if it's 1990 or 2026, fear and greed drive markets, and they always have. Picture a rubber band. When you stretch it far in one direction, what happens? It gets tighter. The further you stretch it, the more tension builds. And the more tension builds, the more violent the snapback when it finally releases. It doesn't just return to where it started, it whips back harder than the original stretch. Stock markets work exactly the same way. The more extreme the positioning in one direction, the more explosive the reversal when it comes. What we're seeing in software stocks right now is one of the most stretched rubber bands I've seen in years. The short positioning is extreme. The underperformance is extreme. And I'm not the only one who sees this. Every institutional trader who's been in this business more than a decade learned the same things I did. They're watching the same levels I'm watching. So how do you know when the snap is actually coming? There are 3 steps. Step 1 is measuring the crowding. Professional investors track something called positioning data. Basically, how much money is betting up versus betting down on a given sector. You can access this through commitment of traders reports, prime brokerage positioning data, even through options flow. Right now, software positioning is as lopsided as I've seen it. There is dramatically more money betting on software going down than on it going up. And that tells you 2 things. First, the pain trade, the move that would hurt the most people, is to the upside. Second, when that positioning starts to unwind, it doesn't happen gradually. It happens in a rush. Have you canceled your Microsoft subscription? Probably not. Have you canceled your Salesforce licenses at work? Your company's cybersecurity tools? No. Because the reality is, yes, AI makes it easier to build software, but selling enterprise software, deploying it across 100,000 employees, getting IT teams to integrate it, getting procurement to sign off, getting legal to approve the contract, that is still brutally hard. AI does not help you with that. The enterprise software flywheel is stickier than people think. The fear was real, but it was overweighted. Step 2 is the crack. This is the technical signal, the moment when the price of a stock or sector breaks through a key resistance level that the bears have been defending. Think of it as the first person on the crowded side of the boat losing their footing. When a heavily shorted stock starts climbing through levels where short sellers told themselves it would stop, that's when the panic starts. The IGV ETF, the iShares Expanded Tech Software Sector Fund, is a good lens for this. It holds 110 of the leading software names: Oracle, Palo Alto Networks, Microsoft, Palantir, CrowdStrike, ServiceNow, the whole category. It got hit hard coming into early 2026, dropping sharply during the inflation fear wave. Those came in around the 74 level, but it's been recovering. It's finding support at the 50-day moving average. Each bounce is holding a little higher than the last. And now, after another brief dip on macro uncertainty, it appears to be stabilizing again. That's the crack forming. I'm not telling you to buy IGB. I want to be clear about that. I'm not your financial advisor, but I'm watching it closely, and I think it's worth understanding why. Step 3 is the force buy, the full squeeze. This is when the boat actually tips. A few people are already falling overboard. The ones who are still on the short side look around and realize, well, if I don't get out right now, I'm going to lose everything I made on this trade. And the only way to close a short position is to buy the stock. You're not buying because you believe in the company. You're not buying because you think the industry is recovering. You're buying because your risk management systems are forcing you to. It's mechanical, it's automatic, and it creates a buying pressure that can move stocks in ways that seem completely disconnected from any fundamental news. Let me give you a real example of this playing out. Avis Budget Group. I bought into Avis when it was set up for exactly this kind of pattern. Rode it up about 80%, took some profits. Then the stock reversed hard, really hard, and a lot of short sellers made serious money on the way down. But then, as the stock tried to recover, the short squeeze kicked in. The stock didn't go up because the car rental business suddenly became exciting. It went up because every short seller who had been profitable on the way down was now watching their gains evaporate, and they all had to buy at the same time to exit their positions. The result? A move of roughly 400% in a compressed time frame. 400%, not because of earnings, not because of news, because of forced mechanical buying. That's the playbook. And smart money is looking for that same pattern in software right now. So how do you actually position for it? The simplest version? Buy IGV. One ETF. One click. You get exposure to 110 software companies across the sector. If the squeeze happens, you catch it. If the rotation rotates slower than expected, you're in a diversified position. It's the low-maintenance way to participate without having to pick individual names. But I also promised you 3 individual stock ideas, so let's get into those. And before I do, let me address the skeptic voice in your head that's saying, but AI really is going to kill software. Let me push back on that with one simple example. Google Docs is free, has been free for years. It's excellent. I use it constantly. I have it open right now. And yet, I still pay for Microsoft Office. Still have it running on my machine. Why? Honestly, I don't have a fully rational explanation. Habit, integration, the fact that my workflows are built around it, the fact that my team uses it. That is enterprise software stickiness in real life. The disruption already came. Free alternatives already exist. And people are still paying for the paid versions because switching is painful, and integrated systems don't change overnight. The AI narrative was powerful. It wasn't wrong, but it was priced in with way too much aggression, and that creates opportunity on the other side. Stock number 1, Commvault Systems, ticker CVLT. Commvault is a cyber resilience and data protection company. Let me be specific about what they do because context matters here. They help enterprises back up data, recover from attacks, and protect their entire data infrastructure. In an era where AI is supposedly destroying software, Commvault is actually one of the biggest beneficiaries of AI expansion because the more AI systems you run, the more data you generate, and the more critical it becomes to protect all of it. AI doesn't reduce the need for data protection, it multiplies it. Every new AI deployment means more sensitive data sitting somewhere that needs to be defended. Cybercriminals are also using AI to attack faster and smarter, which means the tools to defend against them have to keep up. Commvault keeps up. That's their entire business model. The numbers back this up. Commvault crossed over $1 billion in annual revenue, and they're growing that top line at approximately 19% year over year. Their enterprise client base is deep and expanding. They've partnered with CrowdStrike, one of the top cybersecurity names in the market. They recently acquired another AI-focused data security company to extend their capabilities further. And here's the key thing. Nobody cuts cybersecurity spending. When you get hacked, you lose customers, you lose revenue, you lose trust, you potentially face regulatory consequences. Cybersecurity budgets are the last thing to go when a CFO tightens the belt. It's non-negotiable spending. The stock has been hit hard, down roughly 60% from its highs, and it's now in what appears to be an early recovery phase. On the chart, you can see a period of institutional accumulation starting to form after the long decline. The lows are getting higher. The moving average is beginning to slope upward. That's not proof. That's a sign worth paying attention to. Stock number 2, Expensify, ticker EXFY. I'll be up front. This one is small, really small, trading around $1 or so. It peaked near $50. That's a 97% collapse from the top. And I want to be really clear about something. The fact that it's fallen 97% is not a reason to buy it. Cheap on the way down is just cheap. People say cheap right up until a stock goes to zero. That's not the thesis here. The thesis here is different. Expensify runs an expense management platform. Companies use it to manage employee expenses, corporate credit cards, vendor payments, the financial plumbing of everyday business operations. They have millions of users, and despite being beaten down to almost nothing, they are still generating cash. They just completed a $25 million share buyback. That's management putting their own company's money on the line because they believe the stock is undervalued. That's a meaningful signal. They've also done something a lot of their peers haven't done gracefully. They've actually integrated AI into their product rather than running from it. They launched functionality that lets AI assistants like ChatGPT connect directly into their expense data. So instead of being killed by AI, they're using it as a feature. They're becoming part of the AI workflow rather than fighting against it. Chart-wise, the lows are trending higher. The bottoming pattern is forming. We're seeing some institutional buying starting to show up after a long period of silence. Is this speculative? Absolutely. I'm flagging it as high risk, and I want you to hear that clearly. Position sizing matters enormously on something like this. But in a short squeeze scenario where you've got extreme short interest in a name this small, the moves can be violent to the upside. The smallest stocks with the most concentrated short positions often move the fastest and furthest when the tide turns. That's why it's on the radar. Stock number 3, Mara Holdings, ticker MARA. Zoom out on the Mara chart and you'll feel what the buy and hold crowd has been living with. Down about 83% from its peak. If you bought at the top, you've been sitting on that loss for roughly 4 years. That's a long time to keep a secret from your household. Mara used to be Marathon Digital. It was primarily a Bitcoin mining company. And I know what that makes some of you think, but hear me out, because what Mara is becoming is more interesting than what it was. They're pivoting hard. They're acquiring energy infrastructure, including a company called Long Ridge Energy, and they're building out AI data center capacity. They're repositioning themselves from a pure Bitcoin miner into an energy and AI infrastructure company. Whether you like that pivot or not, you have to acknowledge what it means from a squeeze standpoint. Over a quarter of Mara's tradable float is currently shorted, 25%. That is an extraordinary level of short interest. And what do we know about stocks with extreme short positioning that start to recover? The forced buying that follows isn't a drip, it's a flood. If Bitcoin sees any meaningful rally, or if the AI infrastructure narrative starts getting real attention in the market, the short sellers in Mara are in a genuinely painful spot. Getting out requires buying. Buying drives the price up. Rising prices force more shorts to exit. More buying, more price pressure. That's the loop. On the chart, the inverse head and shoulders pattern is the one I take most seriously, and Mara is forming something that looks very much like that. 3 lows that progressively get higher, each bounce holding above the previous one. The stock is grinding up slowly, and I know that feels anticlimactic. You want the spike to already be happening. But that slow grind with rising lows is often exactly what precedes the big move. It won't go up in a straight line. There will be pullbacks. There will be days where it gives back ground and it feels like the thesis is breaking. That's normal. That's part of it. I'm not telling you to buy Mara. I want to be absolutely clear about that. But I'm watching it closely, and it's on the list for a reason. So let me quickly recap the thesis on all three, because each one has a different angle. Commvault is the quality play. Billion-dollar revenue, 19% growth, non-negotiable cybersecurity spending, and a stock that got punished along with the rest of software, even though the AI narrative actually helps their business. That's a fundamental disconnect that tends to close. Expensify is the small cap squeeze play. Tiny, beaten down to almost nothing. Management buying back shares. Genuine AI integration in the product. High risk, high reward, needs strict position sizing discipline. Mara is the squeeze plus pivot play. Massive short interest, pivoting from Bitcoin mining into AI energy infrastructure, and a chart pattern that historically shows up before significant moves to the upside. Three different risk profiles, three different catalysts, but the same underlying mechanic connecting all of them. Extreme short positioning that has stretched the rubber band further than it can hold indefinitely. Now I want to talk about something bigger than just these three stocks, because I think the conversation we're really having here is about how investing actually works in the current environment. The buy and hold playbook is not dead for everything. If you were buying the S&P 500 and holding it for 20 years, I think that's a legitimate strategy, and I would never tell someone to abandon it. The S&P 500 has a long track record of delivering reasonable returns to patient investors. Stick with it. But here's the distinction that matters. Many of you aren't doing that. You're buying individual stocks. You're buying sector ETFs, AI, quantum, space, defense. You're making selections. You're picking. And if you're picking and you're holding those picks like a passive buy and hold investor, you're applying the wrong framework to the wrong game. And if you want me to go deeper on how to read positioning, how to set entries, how to size these kinds of trades, and how to think about the full 5-year IPO cycle that's starting right now, let me know in the comments and I'll keep bringing it. I'm at Untold Empire. That's the channel. That's the commitment. Data before the move. Always. I'll see you in the next one.